Assalamualaikum and hello to Dr. and everyone. My name is Nurul Najiha binti Abdul Latif and my matric number is BB221106774. Today, I'm excited to talk about an important topic in finance: the difference between Islamic bank financing and conventional bank loans. This area showcases how financial system can be shaped by underlying principles and beliefs, ultimately affecting individual, business, and the wider economy. Let's begin with a few fundamental definitions. Sharia law governs Islamic finance, including Islamic bank financing, and prohibits the concept of interest, riba. Islamic finance is distinctive, relying on alternative structures such as lease agreement and profit-sharing scheme, rather than conventional interest-based lending. This means that when you take out a loan from an Islamic bank, you are not simply borrowing money. Instead, you are entering a partnership where both sides share in the risks and rewards. On the other hand, conventional bank loans are based on a straightforward interest model. When you borrow from a traditional bank, you agree to pay back the amount borrowed plus interest over time. Although the structure is simple and direct, it often overlooks the ethical implications that come with charging interest, especially in certain situations. Let's dive deeper into the core principle guarding each system, starting with Islamic finance. First, prohibition of riba, interest. Islamic finance prohibits charging or receiving interest. This principle is based on the belief that money should not be used to earn more money without engaging in productive activity. This foundation will encourage fair transaction and reduce the chain of exploitation. Second, risk sharing. Unlike conventional loans, where only the borrower bear the risks, Islamic finance emphasizes sharing risks. In structure like mudarabah, both parties agree to share profit and loss. This partnership approach fosters mutual accountability and aligns the interests of the bank and the borrower. And third, ethical investment. Islamic finance only support investment in halal permissible industry. This means funds cannot be used for activity related to gambling, alcohol, or other prohibited sector. This ethical filter promotes responsible investment practice that benefits society as a whole. In contrast, conventional banking is more focused on profit maximization and does not necessarily consider ethical dimension. These banks earn revenue primarily from interest and fees, and they can invest in any legal industry, regardless of ethical concept. Next, let's look at some of the key financing products offered by Islamic bank and compare them to those in conventional banking. First, murabaha. In a murabaha transaction, the bank purchases an asset and then sells it to the customer at agreed upon profit margin. This is often used in car or home financing. The customer knows the cost and profit in advance, which adds transparency. Second, ijarah. This is similar to a lease. The bank buys an asset and leases it to the customer for a set period. Ownership remains with the bank during the lease term, and the customer pays rent rather than interest. And then, third, mudarabah and musyarakah. These profit-sharing contracts allow both parties to contribute capital to a venture and share in the profit and loss. Mudarabah is where one party provides funds and the other manages the business, while musyarakah is a joint partnership where all parties contribute capital. In conventional banking, loan products include personal loan, mortgage, and business loans. Each product is structured around fixed and variable interest rates. For example, a mortgage is a long-term loan secured by real estate, where the borrower repays both principal and interest over many years. Business loans help companies finance their operation or expansion plans, often with a fixed repayment schedule. What do these differences mean for borrowers? Let's look at a few scenarios. For Islamic financing, borrower can expect ethical practice and potentially more flexible repayment options. For instance, if a borrower faces financial hardship, some Islamic banks may allow adjustment based on profit-sharing terms. This creates a supportive relationship between lender and borrower and reflects the emphasis on social welfare in Islamic finance. And for conventional loans, traditional loans are readily available and often easier to obtain quickly. However, they come with fixed repayment schedule and are not as adaptable to individual financial situations. Additionally, borrower may face penalties for early repayment or adjustment, which cause add financial pressure. An interesting aspect to consider is the broader impact of the system on the economy and society. For Islamic finance, by emphasizing fairness, ethical practice, and social responsibility, Islamic finance can contribute to economic stability. The focus on real asset backing and ethical restriction often leads to more responsible lending, which can reduce financial risks and promote sustainable growth. And for conventional banking, while conventional banks contribute significantly to economic growth by providing accessible credit, their profit-oriented nature can sometimes lead to issues such as high personality levels or unsustainable lending practice. In times of economic downturn, this can increase financial vulnerability. In conclusion, Islamic bank financing and conventional bank loans represent two distinct approaches to lending. Islamic financing prioritizes ethical principles, risk sharing, and community welfare, while conventional banking is primarily driven by interest, income, and profit. Each system has unique advantage depending on your financial needs and values. Islamic finance can be particularly appealing if you seek a system aligned with ethical and religious values, while conventional banking may offer more accessible options for certain borrowers. That's all from me. Thank you so much for listening. I hope this explanation has clarified the difference between these financial systems. Thank you and have a great day.